Hello everyone and welcome back to the channel. This is Fair Value Finder and today we are taking a look at Salesforce, ticker CRM. They had earnings this week and are dropping rather quickly. So we're going to take a look and see what a fair value would be for the stock and a point that if it falls to, it might be worth picking up. Ideally, we're picking this thing up closer to 160. Fair value around 225 and we'd want to reevaluate around 250. Now, in the last 52 weeks, we've seen it go as low as 194. It currently is sitting at 234 and a half, just about, and it's gone as high as 318, almost 319. Discounted cash flow is coming up with 266. So if you look for strong cash flows in a stock, you might factor in a bit more of a premium to this one. They did come in with almost a 32% yield this last year for their cash flows, so that is very good. On average, they're 25, which is very strong. Earnings yield just shy of 3%. Definitely an elevated share price. There seems to be a pretty big premium baked in on this stock, and for what the performance is out of it, I don't really think it deserves a huge premium. Dividend yield, they did just start paying a dividend this year, so it's going to be a little less than 1%, and we'd really like to see it above 1%. Payout ratio, almost nothing, so they're just doing it to initiate a dividend, and hopefully they grow it pretty quickly over time. That's why we're putting in our thesis 5% growth. We'll see what they come in at. Ideally, they're doing it double digit, but we start out with the safe case, something really reasonable that they have a shot at outperforming. ROE looks really good, 9.2%, and their debt to equity is 0.67. So that is very good. Their balance sheet seems to be in pretty good shape, and they're getting good returns on their equity. ROI, lower, almost 3%. We've seen worse. I would like to see that get up a little bit. And then ROA, about 5.5%. That's decent too. But again, I'd like to see that a bit higher. Margins, they come in around 75%, and this last year that came in at 76. A net 8.32 on average. This last year 15.3. So those margins are very good. Balance sheet is in good shape. Cash flows are strong. It's just a massive premium on the stock, and with everything else, some investors might find that reasonable. But now let's look at their performance and tweak this thesis and see if it is even going to outperform the markets. Revenue, they've been growing strong, but slowing down. 10.5% compound annual growth rate over the last 3 years, 4.5% over the last 2 years, 2.5% over the last year. Analysts are projecting almost 6% over the next year, and then 7.7% over the next 2. So I'm thinking somewhere in the 6 to 7 range would be pretty reasonable. One of the problems with the earnings is they did come in kind of low on the revenue, so I feel like closer to that 6% would be the more reasonable case here, especially with they've been slowing down recently, and we'll see how that shapes up. Share count, they picked it up a bit over the last year, bought back 1% of shares. We really like to see that. Hopefully they can stick with 1%, especially with the share price dropping right now. They can buy back at a price that they find more reasonable. Cash flow growth is something they've always been strong on. Double digits, 29, 21.5, 16. They are up to 30, almost 32%. So I don't know that there's a whole lot more upside to this. If they can stick with the double digits, I think it'd be the low double digits. So we're looking more like 10%. And we'll put that down for the thesis. Even 6% in line with the revenue wouldn't be unreasonable, and just hold at the 32% cash flow yield. That'd be very strong already. Assets, they're slowly growing. 1.6, 1%. Like to see them continue with some small growth there, as long as it's beneficial to the business, of course. And liabilities, they grew them 2.7%, and then they shrank them about a little over 0.75%. So I wouldn't be surprised if it grew in line with the assets and with the good shape that the balance sheet's already in, then that'd be completely fine and reasonable. And then dividends, it just started issuing this year. We'd like to see them come in with some nice strong growth. 5% would bring them to still shy of 1% over the next 5 years. So maybe we go something a bit higher. 6 is in line with the revenues. In 5 years, you'd be looking at $2.14 a year in dividends. And if you buy at today's share price, you're not underwater like we look at some stocks. It looks like you're buying shares at the 2 to 3 year out point, because 3 years, the fair value, assuming that this thesis is the performance of the company, that the fair value would grow to 240 from its current 220. And you'd have an average cost of 234, so you'd be up a little bit. And then in 5 years, if they continue with this performance, we'd see them get above 275, and that'd be 22% growth. You're still underperforming the market. Over that time period, we'd expect SPY to gain about 47%, so you are underperforming the market by about 25%. So personally, I would be looking for a broader pullback in this stock, and I would find it reasonable to buy somewhere around $200 if they can get back to their 52-week low of 193. Slight outperformance in the 3 year, and in the 5 year, you're beating out the market by about 1%. And that's about what you'd expect with a stock that the thesis is giving us a 7.5% annual return, or annual growth in the fair value. Factor into that your 0.5% to 1% dividend, you're making 8.5%, 9% a year. It's just a very solid company, and if you can pick it up at the right price, I think it could be a decent asset to a portfolio. And now we can go and take a look at the prices all graphed out and see if there's any trends that we see here, how everything's doing. And it definitely looks like 2023 forward, we have some good growth across everything. Looks like the share price took a huge hit back in 2022 and has been climbing along with all of the valuation metrics. Earnings were contributing almost nothing in 2021 and have made some tremendous gains. Now they are up into the 200s. The dividend was non-existent, and now that they're starting to pay it, personally, I for that kind of dividend, I'd only really want to pay like $160 a share. So that's definitely not the main driver here. It's a cherry on top of an already good company, but the fair value has stayed consistently down the middle of almost everything here. Some nice growth across the board. Some years better than others, but it just crossed over the balance sheet. The balance sheet seems to be flattening out. Not a huge surprise when we're seeing them grow assets about 1%, liabilities, small growth, or a small payoff. But I definitely like what I'm seeing here. I would just need to pick it up at the right price. So I'll put it on my watch list, and I definitely want to get alerted when it drops below 200 and decide at that point, maybe start picking up some shares and see if it can drop down to the 150s. Of course, at that point, I'd evaluate the business as well, see what kind of moat they have, if their business model has any sort of threat, if there's a new competitor taking away market share, or there are threats from AI. If we can come up with a best case scenario now, I mean, the higher revenues analysts are expecting are about 7.7%. The highest share buybacks that we've seen is 1.02. So we'll go with that. Cash flows slowing down. Maybe instead of 10, we try 15. Assets, 1.5% growth. Liabilities, they pay down 0.75. Dividend, if they can grow that at more like 12%. Margins, 1%. Then we're looking at a much better case here, 10.5% per year. And buying at today's prices, you'd be outperforming the market in the 3-year and the 5-year, 2% and 8% respectively. So not bad. Essentially, you're getting a whole extra year of returns over SPY. But I started out with what I thought was a reasonable case. This is kind of a best case scenario from what they've been able to perform over the last 3 years, and analysts are projecting over the next 2. Now, worst case scenario, see if things don't turn out well, what price could you reasonably pay and maybe just break even? Give yourself a little bit of time to see how things play out. I mean, last year they only came in with 2.5% growth in revenue. They did buy back shares, but maybe they go on the lower end with that 0.6. Cash flows, I feel like a worst case scenario for this company would be in line with revenues, so 2.5%. Assets, I think 1%. I have not seen them do less than that, so I don't want to say that they're going to be forced to sell some of their assets. And liabilities, if they grow at that 2.7 that we saw. Dividend, maybe they come in with something tiny, 3%, basically just outperforming inflation. And then margins, maybe they start to shrink just a little bit. And this is our worst case scenario. So your average return, 2.88%. It's not negative, which is good news. But if you're buying at today's prices, you're basically paying for what they're going to do. Or you're paying the fair value 5 years out if this is what they're able to come up with. Now, if you get in at the 52-week low, you're still underperforming the market, but you are not underwater. Makes me think maybe I do need to put a bit more of a premium onto the stock than I originally thought. Maybe 220 I start looking and buying rather than 200, because even the worst case scenario, it's not a company on the decline. It's very small growth, but it's not setting your money on fire. But there are other better opportunities in the market. Later, I'll soon be putting out my June stocks to buy, and that'll have the companies that I believe are going to be outperforming the market and are down at a reasonable price. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.